Hey, welcome back to Builder Funnel Radio. This is episode 65 with Patrick Camuso. And as we get closer to the end of the year, I wanted to talk taxes and finances a little bit. So Patrick and I talk about the difference between tax prep and tax planning. And then we also dive into some tactical things. We talk about the Augusta Rule, which is really cool. And I think most of you will be able to take advantage of. So sit back and enjoy episode 65 with Patrick Camuso. Hey, Patrick, glad to have you on the show today.
Hey, Spencer, I appreciate you having me on. Thanks for having me.
Yeah, I'm excited for the conversation because a lot of times on the show we talk about, sales and marketing, and we're talking about growing a business, but we can't forget about the financial side. That's a really important piece. And so I know you work with a lot of construction business owners, kind of helping them reduce their taxes and talking about kind of that side of the equation. So thought we could spend some time diving into that today. And but yeah, I guess I'm kind of curious. Maybe you can just kick us off and tell us like how you got into this space and why you wanted to become a CPA.
Yeah, definitely. So I've basically, spent my whole career in the accounting industry. I basically wanted to be a CPA, I guess, since I was like 14 or 15 years old, believe it or not.
Yeah, I do believe that because my wife is one of those people. She knew she wanted to be a lawyer and a judge since she was like 14. So,
Yeah.
But yeah, for some of us, it's like,
a lot of
wow,
people find that uncommon.
Yeah.
Yeah.
So, well, that's nice. You knew your path, right?
Exactly. Yeah. And the reason why is, for me, I learned like around that time that I knew I wanted to be in business, and I was just learning more about all the different components of being involved in business and what that entails. And once I learned that, accounting is basically the language of business and it's the foundation of all businesses, and understanding that would give me the opportunity to understand basically like the base that I need to start any business for myself or any investment portfolio for myself. But it's also a way for me to build, a strong reputation and network while also building my own CPA firm. That's really what led me to, sort of following this path of becoming a CPA and opening my own CPA firm. So, that's sort of been my goal since then. So after high school, I went to school for accounting and for finance. I double majored in both of those. I got my CPA. I worked about 5.5 years in one of the top Big Four accounting firms, mainly in the private equity and financial services space there. And then after that time, like 5.5 years, maybe a little above that, I went and started Camuso CPA, and I've been consulting there ever since. And, we work very heavily with both real estate investors and construction businesses on, like you said, like on taxes and accounting.
Cool. Yeah, that's awesome. It's good to hear the background. I know for a lot of our listeners, the topic of something like tax planning will come up. And I feel like, I don't know, maybe we should just break that down a little bit. Like, what does that actually mean when somebody just throws out the term like, oh, we better do some tax planning, or we're coming up on tax season. Like, what should we be thinking about? And, I guess maybe dive into that a little bit. What should we think about when someone says tax planning?
Yeah, I'm really glad you asked that because, many business owners aren't really familiar with that term. And they're not even familiar that service is out there for them. And there are a lot of CPAs that may be out there that don't offer tax planning as a service. And, some people may say that they're doing their clients a disservice, but what I would say is any client that needs tax planning is, not being diligent in their business if they're not going into the marketplace, seeking out the correct services that they need. And the first step of that really hinges on your question, what is tax planning? And like I said, a lot of people, when they're getting their tax return prepared, they think that they're optimized from a tax perspective. They're minimizing their taxes as much as humanly possible. But that's really not the case, because when you're doing tax return preparation, your CPA or your tax preparer is taking an historical look. Keyword is historical look at your tax return. So they're looking back at the last year at your profit statement and balance sheet, and they're seeing what took place, and they're accurately and reporting that to the IRS in a timely fashion. And that's the point of tax return preparation, historical. Now, tax planning is all about being proactive and taking a forward-looking approach, looking at, all right, here's where you are now. on this date here in 2019, here's where you think that you're going to be revenue and expense wise for the next 2 to 4 years. Let's plan around that and make sure that you're optimized going forward in how you conduct your business to be streamlined for your accounting and, minimize from a tax perspective. And that can include a wide variety of things, your legal entity structure, maximizing your tax deductions, ensuring that you've selected the right accounting method for your business to be optimized from a tax perspective, making sure that you're handling retirement and insurance planning within your business from a tax perspective as efficiently as possible, going through recent regulatory changes that may impact your business, advanced tax planning strategies. There's a wide variety of things that we can look at there, but the big difference is, tax planning is historical or tax preparation is historical, and tax planning is looking into the future.
Gotcha. Yeah, that makes sense. And so if we're looking towards the future, as we come up on tax season, it's kind of too late to do any tax planning for that year, most likely. Mm-hmm. But then now we're looking ahead. So I guess in terms of, looking ahead, if you're a construction business owner, are there any quick wins that people can be looking for that maybe, you're seeing in your day to day that people are kind of missing or that people should be looking out for?
Well, I think that there are, and, I think I can probably highlight one of those, but I would stress tax planning isn't something where you should be trying to target a quick win. It's more of a systematic approach. So, all those things that I listed off, if I was to take someone through a tax plan, I first want to take a look at what legal entity structure, after looking at your profit and loss statement, your balance sheet, all your financials, I'd want to take a look at what legal entity structure are you in? What method of accounting are you utilizing for tax reporting purposes? What tax deductions are you taking? And in each of those buckets, there's going to be opportunities, based on your facts and circumstances to minimize your taxes and, to take measures to protect your assets. So you never want to just try to look for, a quick deduction here or there, because you may be leaving things on the table, and you may very well be looking at capturing some type of tax deduction that, based on your entity structure, if you don't take the correct measures throughout the year, it may not even become deductible come tax time. So it's really about creating that systematic approach and having a roadmap. That being said, year end is really a key time for tax planning, because it's that final opportunity to where you're going to be closing out your tax year. So, as a construction business owner, one thing, it's first and foremost, it's important to really start getting a tax projection set up for yourself and starting to look at everything on a project by project basis. How much revenue are you anticipating to collect on contracts by the end of the year? And, where do you expect your project level expenses to be at respectively for each of these projects? And then starting to look within that, are there any ways, and obviously your accounting method comes into play on this as well, and you see how it all gets layered on. But, based on where your projects are at, are there any ways that we can possibly accelerate some of the project level expenses to, lower your overall income that you're reporting to the IRS? Again, but it's going to be based on your method of accounting. That's one thing that we can look at within sort of accelerating year-end expenses. Obviously we live in a political world nowadays, so everyone probably heard about the 2018 Tax Cuts and Jobs Act. That was a significant overhaul to the tax code. And this is one area where there are some new opportunities for business owners, and there's a lot of things to cover there. We're not going to be able to cover them all on this podcast, but one really interesting one, if you're a construction business owner and you're in a position where, you are looking at a large tax liability and you're planning to grow your company over the next, let's say, 2 years, most likely you're going to be looking at purchasing or financing some equipment at some point. And now may be the time where if that was in your plan, say in the next 6 months, next year, maybe even next 2 years, depending on your cash flow and the rest of your projections, we may want to accelerate the purchases of some of that equipment. Because one of the new changes with the tax laws that I mentioned, with the 2018 tax laws, is that equipment, whether it's new or used, can now be expensed basically in the first year that you purchase it, if you put it to use. So you can purchase, like a $2 million piece of equipment on December 28th, and as long as you place it into service, meaning that you use it for business activity, even if it's just for an hour, as long as you place it into service, then we're able to take that full expense in the first year. How do we take that expense? There's a few different methodologies that we're going to use to take that on your tax return. That, you know, probably doesn't matter for the sake of this conversation, although we can get into that. But that's one quick win that if you're a construction business owner and you're looking at a high tax liability, like one of the first things I want to look at is how can we accelerate some of your expenses.
Yeah, that's a great tip. And I think, yeah, for everybody, you know, right now we're in a great economic environment, you know, so a lot of people that we're talking to are super busy. They're booked out through, you know, Q1, sometimes even into Q2 a little bit with projects. And so to your point, like if you're going to have a good year, like, hey, what are some things that maybe you can do to accelerate job projects, you know, so you can pull those expenses into the current year. Or if you were going to make some purchases and you're looking ahead, then hey, go ahead and maybe jump on those now, you know, as we hit the end of the year, and then just accelerate the, you know, putting that towards this year's expenses. So those are, yeah, those are great tips. And I think really timely too, because a lot of people are having some really strong financial years. And so that's always the key is like, hey, we know at some point this is not going to continue most likely, but we don't know when. And so if you're in a position to kind of like, you know, buy some equipment and put yourself in a really solid spot for when maybe things are tough, and that equipment might be a differentiator or allow you to be more efficient or whatever it is. So yeah, those are great tips. And so have you ever seen, just kind of an oddball question, because I also like the numbers. I don't know as much as you do in this arena, but I think it's fun and interesting. Do you have like a kind of crazy, unique, or like off the wall strategy? I'm sure people like ask about that sometimes, or you've seen like some unique scenario, and I don't know, just kind of a more of something that maybe isn't your standard, you know, run of the mill scenario.
Yeah, I mean, every tax planning scenario is unique, you know, to each person's business and finances. I probably don't have anything too crazy. You know, for any expense to be tax deductible, it needs to be not only related to your business, but also necessary and ordinary. So that's always the restriction with taking an expense. But there are some, you know, interesting things that the tax code allows. One interesting thing that I've seen people do, and that, you know, I've done with people, is something related to something that it's not the it's referred to as this. It's not, the tax code doesn't refer to it as this. It's like a nickname, but it's called the Augusta Rule. And basically, there's this provision in the tax code that allows you to rent your personal residence out to anybody really for 14 days without paying tax on it, as long as you rent out those days not consecutively. So, you know, if your business has a board of directors, or if it has multiple shareholders, and you're doing monthly board meetings, you can convene those actually in your home, and your company can pay yourself rent. And then under the Augusta Rule, if you meet the applicable provisions with that, your business is going to show that rent as an expense, and then you're collecting it as income, and then you don't have to claim the tax on that. So it would be you know, a legal way to shift income out of your business to you personally. So I think that's one interesting one on the business side. Another interesting one I was just working on a tax plan that's not business related. It was with a construction business owner, but they're also a real estate investor. And you know, I was just going over with them basically the strategy of, they like to buy multifamily apartments. And one interesting area of tax planning, going to how it's more systematic, is that a lot of times combining multiple tax strategies leads to even a more powerful outcome. So with them, you know, when they purchase a new property, most likely we're going to do what's called a cost segregation on that property. And we're going to try to accelerate the depreciation deduction on that property to get the most of that we can in the beginning years that they own it, with the plan of them most likely selling these properties in a 3 to 5 year time horizon. That's when you get the most depreciation benefit. Then when they sell the property, they would have to pay capital gains on that property. But then we're going to use a strategy called the like-kind exchange. So then they can defer paying capital gains on that property, as long as they follow all the provisions within that section of the tax code. Now, you know, and then they rinse and repeat the cost seg, the like-kind exchange in perpetuity. And then when they die, they can pass their assets to whoever is going to get their inheritance tax-free up to certain amounts, because they're going to get a step-up basis in their assets. And even if they don't want to keep purchasing properties, we have something else that they can utilize in place of a like-kind exchange, which is basically a deferred sales trust, which is another form of basically doing a like-kind exchange. So that's a way where it's really interesting, because we're enabling that investor with a roadmap to basically never pay capital gains on the properties that they purchase and sell, and that could be millions of dollars of capital gains. So there are some interesting things that can be done, but usually none of them are like that crazy or sexy. It just all sort of comes down to the details, and then all of a sudden the numbers can get pretty big.
Yeah, no, and those are great examples. I mean, I think a lot of our listeners, end up owning real estate or having that as a part of their investment strategy, and so that's a great example. And actually, I'm glad you mentioned the Augusta Rule. That was something we here at Builder Funnel just started implementing this year, because if you have, we have an owners group, and so even if your owners group is just you and one other person, you and a spouse, hey, if you meet at your house and you do that quarterly for your owners meetings or board meetings or whatever you call them, just look up the Marriott right downtown that we normally would have rented a room from, it's $100 an hour or whatever, just figure out that similar rate and then charge it to yourself. But it's a good way to pull money out of the business tax-free, like you said. And
exactly.
Yeah, it's a great strategy there. But you said a couple of nuances there. You said 14 days or less, right, is how often but it can't all be together.
Yeah, so there's some nuances with that rule, and to any tax deduction. That's why you want to make sure that you're working with a good CPA that can sort of guide you through all of these intricacies. So it's 14 days or less, and they have to be non-consecutive. So you couldn't, for instance, do that Monday through Friday. It works perfect for board meetings though, because you can do that once a month, 12 non-consecutive days. You're golden from that perspective. And then, like you said, you want to make sure that it's audit proof as well. So you want to compare your comparable rates. Like you were saying, you also want to draw up a lease agreement between, your company and you personally. And then each year, at the end of the year, you'd also want your company to pay you a 1099. Now, you wouldn't have to claim that income under the 14-day provision, but those are basically, the steps to take to make sure that it's still staying arm's length and sort of will stand up to scrutiny. But those are some of the details to it. Off the top of my head, there may be something else.
Yeah,
but, make sure you work with a CPA. But
don't worry. This is informal conversation, so everyone make sure you're doing your due diligence. But that's good to know, and I think that's like an easy thing that most people can implement that are listening. It's just an easy way to pull that money out and tax free, because you don't have to take that.
And to that point, that's like you said, that's a great one, because it doesn't require any cash outlay. So there's the tax system as a whole is, the way I look at it is, it's an incentive system. And basically, what the government's trying to incentivize in the form of tax breaks is that, their citizens have more jobs be provided to them through business owners. So they're offering benefits to business owners, and they want more affordable housing provided to their citizens. So they're offering benefits to real estate investors. Now, most of these incentives, they're trying to get you to do something with your dollars. So when you get into many tax deductions that you're eligible for, many advanced planning strategies, it's going to require some form of cash outlay. So there's going to be some trade-off that potentially comes with that, unless it's already a sunk cost in your business, or unless we're looking at some type of non-cash deduction, like the Augusta strategy, like maximizing depreciation in some arena, even if it's on equipment with construction. So that was just a good point, I thought, to bring up that you made there.
Cool. Yeah, I appreciate that. And we always like to make these a combination of exposure to new ideas, but then tactical things. And I think that's an easy tactical thing people can jump into. Earlier you talked about tax planning. A lot of times you have to look at entity structure, and that's going to determine which path you might take. So we don't have time to break down all the entities and pros and cons, but generally I think a lot of people either just set something up the way they did just because there wasn't a rhyme or reason, or they inherited it. Maybe they bought into the business and it just was set up a certain way. So maybe you could just talk a little bit about like generally, why you might go the LLC route or S-Corp or, some of these different methods. And then is there a common one that you see in the construction space that, you end up in this bucket or this bucket, but that's pretty much it, that sort of thing.
Yeah. Now, first to that point, if you're setting up an entity for a construction business, make sure you speak with a CPA and most likely a lawyer as well. It's not a mistake that you want to have to be on time with someone years down the road when, you have assets within the company and you have a lot of cash flowing through the company. It can really become a major headache. And, what a CPA is going to offer you is, tax and financial advice. And what a lawyer is going to offer you is legal and business advice. And both of those go hand in hand, especially if it's a partnership. So, don't take that consideration lightly. Now, in terms of, and the other thing I want to make to that point, in terms of practical advice, if you're someone right now that's like, I'm not going to talk to a CPA or a lawyer, I'm just trying to get my first couple deals under my belt, then start a single member LLC, because from that step, we can do almost anything with that. We can turn a single member LLC into a partnership. We can turn it into an S corporation. We could turn it into a C corporation, through additional filings. So it sort of gives you flexibility in the future if that fits your fact pattern. Now but now in terms of what entity is optimal, now the way that I would determine that for you, and basically any other CPA is going to determine that for you, is through a basic tax projection, taking where you're at for first for 2019 and seeing, let's say you're an LLC now currently. We'll take you at 2019, project out your tax liability as an LLC, and then do that respectively for the same tax year for an S-Corp and a C-Corp. And then we would project that out over, a multiple year projection based on what you expect your business to be doing. And that's the clearest and easiest way to see, all right, this is going to give you the best net profit and help your bottom line the best. This is what it's going to look like managing your company in this format. And that's how I really start to drive that conversation with somebody. More likely than not, and that's how I think everybody should do it. I don't think you should take rules of thumb and, ever take your decision in terms of your entity structure lightly. And the same thing goes for choosing your accounting methods, even though that's a completely separate conversation. That's probably next after the entity structure. So I would keep that in mind too. But most likely where you're going to start out is you're going to start out as an LLC or a partnership. And then you're probably going to upgrade to an S corporation. You may end up going into a C corporation depending on your facts and circumstances. One of the big differences between an S corp and a C corp is that a C corp has 2 levels of taxation and an S corp has 1 level of taxation. But one of the changes that just took place that makes this decision a little more neck and neck was 2018 Tax Cuts and Jobs Act, because the corporate tax rate is now much lower than it used to be. So that makes the C corporation structure much more attractive to companies. But now if you're planning to take a lot of distributions outside of the company, more likely than not, an S corp is going to be a more attractive choice for you because you're avoiding 2 levels of taxation. But when we're looking at that choice, we have to take a look at the corporate tax rate versus your personal tax rate. Also consider, what stage of business are you in, and what level of expenses are you projecting, and what level of profit are you projecting. But more likely, if I had to guess, I'd guess an S corp. But it can vary, and I have seen multiple types of entity structures.
Cool. Yeah, that makes sense. And then good to know on the C Corp too. I mean, just if people ever do look at that, and that starts to make sense that change, occurred.
Yeah.
Because you do have that double tax there. Let's shift and talk about a little bit of benchmarking. I know you work with a number of, construction businesses, and so you get to see like the numbers, and I think when a lot of business owners get together, sometimes numbers are shared, but sometimes it's vague. And, so are there any benchmarks that you see in terms of like profit per job or overall profitability that people should be, looking at and aiming for, something to be aware of?
Yeah. So, after you have a solid tax plan in place and after you have, a very strong accounting system implemented, the next step to your financial and business success as a construction business owner really is going to be, accurately benchmarking your company to help get you to that next level of profitability and help really zero in and drive on the changes that you need to make in your business. So, it's an area that once I get those preliminary pieces in place for a client, it's an area that I find myself focusing on a lot with them just because it's honestly, like the next logical step basically. So, in terms of net profit, now when I say net profit, that means that, that's going to include the salary that the owner's paid as an expense. So your net profit's not including your salary in terms of you thinking what you're taking home. Usually between 8 to 9%, for most construction businesses.
Cool. Yeah, that's
And then,
helpful.
and then based on that metric, you want to basically, when you get into estimate, and if you're a construction business owner and you're out there right now and you're listening to that and you're way under that, it's most likely going to be a function of you not marking up your direct costs properly when you're estimating your jobs. And it's just basically all goes back to benchmarking and, applying the right markup percentage to your direct costs when you're creating a bid for a job. And if you can estimate where your direct cost should be at, I would say usually around 60%. Indirect costs usually around 21%. Overhead usually comes in around 7% or so. You could basically, what I work on a lot at this stage when we identify, all right, we're not charging enough for our projects, which is common, especially if you're in the earlier stages too, starting out, is we need to basically make a formula that says that accounts for taxes, accounts for profit, and accounts for direct costs, interest costs, overhead, and then we arrive at whatever your markup percentage should be. And then that's how we start to sort of remedy that problem. If net profit 8 to 9%, and if there's an issue with that, the first thing I would start taking a look at is, what markup percentage are you applying to your direct cost? And then from there, it's probably a project management issue in terms of change orders and, setting expectations properly with clients.
Yeah. I think that makes a lot of sense. And you said overhead might be around 20, maybe said 21%, I think, or somewhere in that ballpark.
Yeah, I think of indirect costs and overhead separately. So overhead, when I think of overhead, I'm thinking of just like marketing, legal, professional, office expenses, meals. That's what I think of like pure overhead. Then we have indirect costs that are related to specific jobs but aren't directly related to one job. Maybe that's a piece of equipment. Things of the equipment, payroll costs, management fees, things of that nature. Those are all going under indirect costs. So your indirect costs are usually, I would say, about 21%. With your overhead, which that would include your marketing, legal, that's usually about 7%.
Okay, gotcha. And so that split, do you see a common thread, I guess, in terms of like what percentage people spend on marketing or marketing and sales, underneath that bucket?
Yeah, so legal and professional is usually going to be about 2 to 3%. Your office expenses are only going to run you about 1%. So usually I see about the rest of that going to marketing.
Sure.
Depending at what stage of growth you're at, once you're projecting like this, we can decide on a project basis. Do you want to take a couple points of your net profit and reinvest that back into the company as a business owner? And that's where, you hear that term reinvesting back into your company. Now, I would recommend doing that before year end, and, we'll keep that money within the company. We'll take it as an expense. But, you can put more in it, but knowing it's coming out of your net profit. But we want to stay within that 7% range, that band there for overhead expenses. So, the best way to do that would be you could fairly simply project out your accounting costs. If you're working with a good CPA, like, all of our pricing is fixed fee upfront pricing, that should be fairly estimatable, along with most of your legal costs, although there's probably going to be a little more variability there. And then, office and meal expenses are fairly easy to allocate a percentage to. So we would leave the remainder for marketing. And then if we wanted to increase that, it most likely is going to have to come out of net profit because there's nowhere else to take it, you know?
Sure. Yeah. If you're trying to grow really aggressively, then
Mm-hmm.
you're gonna have to invest versus pulling
Mm-hmm.
it out of your budget numbers and what
Yep.
you're trying to achieve. Yeah. And so, just jumping back real quick to owner's comp, I'm glad you kind of made that point about the net profit 8 to 9%, but that's after owner's salary.
Mm-hmm.
Do you see? Is there a good way to figure out like how much should I be paying myself as an owner? Should it be a percentage of top line sales? Do you compare yourself to like um, if you had to hire that job out, like what would you have to pay somebody, or kind of how do you go about that? I know it's a very personal question too for the actual owner and what kind of business they're trying to create, whether it's a lifestyle business or they're trying to grow it aggressively,
Mm-hmm.
but just maybe ways to think through that.
Yeah, and there's two considerations to that question. One's a tax consideration and one's just an overall financial consideration. Because, first from a tax perspective, if you're in an S-Corp or a C-Corp, you have a reasonable compensation that you're required to pay yourself as an employee of your corporation. And since when you're paying employees wages, you're paying self-employment tax on those wages. So the amount when you're a shareholder employee, you get to decide how much wage you pay yourself. So there can be some scrutiny around that with the IRS since you get to decide that. So, there are multiple ways basically that the IRS permits you to calculate what they call a reasonable compensation for a shareholder employee. So from a tax perspective, we want to make sure that we're accurately calculating a reasonable compensation that your company is going to pay you if you're in one of these entities. Now, the way that we do that is there's multiple calculations methods that the IRS utilizes that we don't have to go into detail about, just because it's not necessary.
Sure.
But basically they're all based off of looking at what duties you perform within your company and then comparing that to just reliable data that's out there. And there's a few different sources that they'll utilize, such as like the census and different sources from other labor statistic pools where we can see, across the United States, if you live in Charlotte, North Carolina, and you run a construction business that does $5 million a year or like $5.5 million a year, and you have 5 employees and you have this level of experience and you perform 5 hours of marketing duties a week and X, Y, and Z, it takes you through all that. There's a way that we can compare that with all this data and say, all right, well, your peers are getting paid $125K for this, and that's what your reasonable comp is. And the IRS wants you to pay that unless we have a good justification, for your business operations are lacking or, other reasonable justifications. The IRS wants to see you pay that because they want their tax on that. They want their self-employment tax. Yeah. So you got to keep that in mind from a tax perspective. Now, when you get into the financial perspective, usually, if you're running a construction business, if you're running a healthy construction business, you want your salary usually we're going to see it is 100 to 150K. And usually your salary, you want to keep as low as possible in most entity structures, because it's going to benefit you to take that money out of the business another way. So we want to take your salary to the level that you have to take it, and then you could take out more in profit. Always remember. So usually 100 to 150K for your salary. With that being said, now as the business grows, your salary is an element of your direct cost. It's going to go under your management fee, or it's an element of your indirect cost, and that's going to go under your management fees. And that's usually 21%. So that overall number, if you got a $20 million construction firm, that overall number is going to grow because you're going to have more people that you're putting on payroll. But your personal salary that you take home is probably still going to be around that 100 to 150K mark. And, it could get raised incrementally, but most likely it's going to benefit you more to start taking that out as profit.
Gotcha. Yeah, that makes sense.
And if it doesn't, then we can take out more as a wage, but it gets very situational.
Yeah. And I think that's a good, everybody listening to this knows that like this stuff should be highly personalized to you. And these are good, like, general things to think about. And, you know, if you haven't maybe thought through different scenarios, I hope that this conversation has been pretty helpful to people. Patrick, I've got a few more questions for you, but before I get to those, I guess if people want to dive in a little deeper and connect with you, or, you know, find you online, like, what's the best place they can reach out?
Yeah, definitely. So, you know, if anybody wanted to reach out to me, and also if they wanted to learn more about, you know, taxes and accounting as it relates to their construction business, or even if they have a real estate portfolio, visiting our firm's website at camusocpa.com is the best place to go. So, you know, if you want to get in contact with me directly, you can reach out to my team at the contact us page at camusocpa.com, and, you know, we'll get you right on the schedule to speak with me one-on-one. And usually, you know, I'll do an initial strategy session with the client for, you know, anywhere from 30 minutes to an hour, no charge, just to really see where your business is at, explain to you how we work, and identify any opportunities for you. And that's usually how, you know, I start to build an initial client relationship. And there's also a ton of tax information there as well on our blog, on our tax guides. And, you know, you can, if you're just looking to learn more, that's a great resource for that as well.
Cool. Yeah, appreciate that. And we'll link that up in the show notes too, if anybody wants easy access to that. So now we're on to the last segment of our show. It's 5 quick questions we ask every guest. We call it the Fast 5. So I'll kind of just rapid fire these at you, and you can give me quick answers. But,
okay.
So what is your favorite business book and why?
My favorite business book. Oh man, I guess when I was a little kid, I read Robert Kiyosaki's book where he shows those 4 quadrants, and that's had a huge impact on me. So, you know, that would have to be one. I did spend a lot of time, you know, working in the Big Four, like I said, before I started my firm here at Camuso CPA. One book that helped me a lot there was by Robert Greene, called The 48 Laws of Power. So, you know, those are 2 big ones. I also like his book Mastery a lot, just for, you know, overall, like, trying to keep a focus on being a CPA for so long. You know, that one goes a long way. So I would say those are probably in my top 3. But for me, I try to consume a lot of business books, and a lot on one subject at a time, and just try to take in all the information. I think it's a amalgamation of everything rather than one book that really helps to push things forward.
Yeah, I found that as well. I typically read quite a bit every year, and I find that the more books you read, the more, like, connections you start to see between all of them. Yeah, it's pretty cool. Mm-hmm. All right, next question. Who is the most inspirational person in your life?
Oh, the most inspirational person in my life. Oh man. You know, I guess I would have to say, obviously, God is number 1. Outside of that, I'm expecting a baby this year.
Congratulations.
Yeah, awesome. Actually in like a week or so. So, you know, puts a lot of things in perspective, and it sort of is very motivating to just get that perspective from a new person, and just really push me to, you know, taking the next steps in my business and my personal life with my family. So, you know, I would have to say, I guess, my son, even though he's not here quite yet.
Yeah. Oh, very cool. All right. So if you could have one superpower, what would that be?
One superpower, man, to be able to read people's minds, because, you know, perspective is reality. And if I can see into everybody's mind and know what they're thinking, I think that's going to give me all the advantage I need in this world.
Cool. I like it. Yeah, that's a good one. All right. Describe yourself in 3 words.
Oh man, describe myself in 3. Is this like a humble brag question here?
No, it's just whatever you want. Yeah, whatever comes to mind. People are learning a little bit more about you.
Hardworking, curious, and hardworking, curious. I think I only got 2, man. Hardworking and
we'll
curious.
Count hardworking as 2, and then you got 3. So yeah. Cool. I like it. And then final question is just, hey, if you could leave our listeners with one piece of advice, what would that be?
You know, if you're out there and you have a construction business that is, you know, on the spectrum of success wherever you're at, take your taxes and your finances seriously, because I hate seeing people leave money on the table with the IRS, or, you know, cut their business aspirations short because they're not managing their basic accounting functions properly. You know, the reason, like I said, I got into being a CPA is because it's the foundation of your business. I know it's not the most fun part of a business, and if you're out on the site all day, you probably don't want to come home and talk to your CPA. Trust me, I understand, but it can save you thousands and thousands and thousands and thousands of dollars, and you'll save those every single year. So, you know, take the tax and the finance side as seriously as laying a foundation or a footer, and I think it's going to help your business a ton.
Cool. Yeah, that's great advice. I'm kind of a budgeting nerd when it comes to that sort of thing on the personal side, just running like a good household budget. And I always say, you know, control your finances, control your life. And I mean, it just adds so much stability, removes stress, anxiety, like all these things. And so I think, to your point, like, don't take it lightly. And that's great advice. And Patrick, yeah, thanks so much for joining me today. I think this has been really helpful, and I hope a lot of people kind of pulled out a couple of things that will at least make them pause and think, and maybe make some changes moving forward.
Definitely. Yeah, I appreciate you having me on. Thanks again.
All right. Thanks, Patrick. Hey, guys, I hope you enjoyed that episode with Patrick Camuso. And I know you're on the go, and I always like to pull out some action items from the episode, from the conversation. So I just have one for you today, because this is so hyper personalized to all of our specific situations with the way we have our business structured. And if you're having a great year or a bad year, it's just going to determine what action you might take. So my recommendation is just sitting down with the CPA and reviewing this, but in advance of the end of the year, so that you can actually start to look for some opportunities. So if you're having a great year, you may want to make some purchases or make an investment that you can write off. I think the Augusta Rule is something you can implement right away. If you have like a end of the year planning meeting with the owners group or whatever that may be, you know, that's a good way to pass some money to yourself personally, tax-free, get it out of the business that way. So yeah, I think at the end of the day, there's really the one main takeaway is just being proactive and making sure you get a meeting on the books in the next week or two, talking to somebody, either your existing CPA or finding a new one, or if you don't have one, finding one, and looking for those opportunities as we close out the year. So hope that helps. Hope you enjoyed this episode, and we will see you next time on Builder Funnel Radio.